Hey guys, welcome back. Episode 2 of the TMG podcast, the Mortgage Guys podcast. And I'm here with a very special guest, Frankie here. Frankie, they call you like number one.
I mean, some people call me number one. That's right.
Yeah, so Frankie, I want to get started here just really quick. A lot of people know who you are, but a quick intro. You're a loan officer here at TMG. Tell them a little bit about yourself before we jump into like how you've helped your clients with certain loan types right now.
Yeah, of course. So as you mentioned, I'm a lender here with the Mortgage Guys. I've been here for going on 4 years now with the company. Started off as a loan as a loan officer assistant. Grew my way into getting fully licensed, and now I've had the pleasure of helping in the last year, since getting licensed, at least 250 plus families get into their homes and expand their real estate portfolio with investment properties and all types of real estate transactions. So we've been blessed to be able to help these people and help them stay informed and build these relationships. And fast forward to today, we're continuing the momentum, we're continuing the aggressiveness, and that's pretty much in a nutshell.
And Frankie, a lot of people right now watching this show right now, they're thinking like, man, you know what? The market is a little bit bad. Or they hear things on TV or family members, and they're thinking, I'm going to wait till next year when the rates come down. However, there's a lot of opportunity right now.
That's right.
So like, I feel like if people buy right now when rates are higher, they're going to get a better deal, because if they wait till rates come down, then properties are going to be higher. So not only that, the holidays are here. So I think it's a great opportunity to jump ahead of the competition and get better deals. How do you feel about the market right now?
I think to your point, there are two types of markets. So there's a seller's market and then there's a buyer's market. Currently, we're in what's called a buyer's market. Reason being is in a high interest rate market, sellers are more inclined and more likely to agree to closing cost credit, to agree to make those repairs before you close escrow, or even to credit you credit towards your closing to buy down your rate. So in this type of market, the buyers are the ones that are benefiting from the higher interest rates, the lower percentage of offers that sellers are receiving, and in turn the buyers are able to get that credit to help them out. Now when the rates when the rates are lower, let's say 3, 4, 5%, sellers are less likely to agree to giving you that closing cost credit, to agree to buy down your rate, because as opposed to giving you that credit, they could decline your offer and accept the next offer. So there are pros and cons with both markets, but I do think that right now buyers have the upper hand in this market. And
then right now there's a lot of opportunity with FHA loans. You've been having a lot of good, you have a lot of good stories of clients that they got a better deal going FHA. Why is FHA a good option right now?
So what we have to remember is FHA is a government program, and what it's meant to do is incentivize first-time home buyers. The way it does so is it allows you to purchase with as little as a 580 FICO, even a 550 in some cases, believe it or not. They're also a little more flexible when it comes down to your debt-to-income ratio. So it gives you a little more flexibility if you have a little more debt than the normal person. That's possibly the program for you. And on top of that, it does also have more competitive pricing than a conventional loan does. So the benefits of going FHA as opposed to any other program is that it is meant to incentivize first-time home buyers. So the terms that you're going to be receiving are a lot more beneficial.
What about the income right now? Like, I know a lot of people don't make the income that they need. What if you combine, what if you add a cosigner? What's like a story of a client that you had that maybe added a cosigner, maybe the daughter, the son? Do you have a crazy story of a loan that you did for a family?
Yeah, I mean, I think what we're seeing a lot right now is, with the higher interest rate market, higher price points, buyers are needing more income to qualify for the same amount as they would previously. So we're seeing a lot of families come together, uncles, aunts, cousins, brothers, sisters, mom, dad. They're coming together, combining their income, combining their FICO, and seeing what they could purchase together. Just really understanding that first purchase, when you guys, are combining incomes or whatever the case may be, 3 or 4 borrowers, you're able to kind of take that first leap and take that first step into building building your real estate portfolio. So I think that that's the important factor to consider right now is you may need a little more or a few more borrowers to qualify for that same price point that you would have previously. But, it's just a matter of taking that first step and, understanding the bigger picture. That I think that's the biggest factor, is that a lot of people are thinking short term and they're not thinking long term in regards to investing in real estate.
And then another option too, like if you're watching this and you're thinking, man, if I buy FHA right now, 10 more minutes. If you buy FHA right now, then I'm going to be stuck with that interest rate. And I'm going to have to then, what if I get laid off? What if something happens? What if I get hurt and I don't have a job anymore? I don't have any more income, so I'm not going to be able to refinance anymore. But even if income drops, there is something called an FHA Streamline. So how easy, can you talk about how easy it is to do an FHA Streamline? Because people buy right now. So let's say the property goes up 10% if they wait for next year. They're going to pay 10% more. However, and I'm just making the number up, it could be even more, right? It could be a little less, but it could be a lot more. But if they buy right now, FHA, how would a Streamline work? What if in 6 months, the rate drops by X amount? Like, how much does the rate have to drop? And do they have to show all their income docs? Do they have to go through the whole process, order appraisal? Can you talk about how easy it is to do a Streamline? That way, like, people are not afraid to buy right now, because in as little as 6 months or 6 payments, you can explain it to them. You could just do an FHA Streamline like this, won't cost you anything or very little, and then they get the rate lower. How does that work? So
to Albert's point is, with FHA, although, because that's a common obstacle, that's a common hurdle and a question that new buyers are interested in. And this is the first question that comes out of their mouth is, in regards to what the rate is. So when it comes to FHA, you also want to paint the bigger picture. You want to give them the information that this is not although it is a fixed rate, this rate is, you're able to take advantage with FHA every 6 months, considering the market allows it, you're able to take advantage of the best possible rate. So the way it works is, with FHA, if you did purchase with an FHA loan, you're able to do what's called a Streamline refinance within the number. As soon as you make your 6th payment, you're able to do an FHA Streamline. And in turn, what that's doing is, let's say you purchase right now at a 6.5% rate. 6 months down the line, the market has improved or whatever the case may be. Now we're looking at rates at about 6%, which is a 0.5. So it has to be a 0.5 net tangible benefit for the client. And in essence, what it is letting, the Federal Housing Administration know, if somebody can, pay for their mortgage at a 6.5 rate, then they are more than able to pay for their mortgage at a 6% rate. So the benefit of doing an FHA Streamline is that we don't need an appraisal. We don't need any income verification. It's a matter of a 2-week process. Really what we're doing is we're just adjusting your current rate. If it is higher than where the current market is at by a minimum of 0.5%, so that's 0.5%, we're able to then refinance your loan and get you into a lower rate, reduce your monthly payment, still stays with an FHA loan. So you don't necessarily need 20% equity. You can buy a house today, and by the middle of 2024, if the market allows it, get that rate reduced and be in a position where you have a more comfortable payment. You've already been able to make your payment for the last 6 months at a higher rate. So now you're going to be able to, either cash flow, increase what you're investing into your savings, whatever the case may be. So we just need 6 payments, and after that, we're able to consider where the market is and get you Streamline refinanced.
So just so you guys get an idea, when rates were coming down, I remember like when rates just started coming down a lot, like some clients did a Streamline, like even, 4 or 5 times. Like they did a Streamline, another Streamline, another Streamline, and they went from like a whatever rate they had, let's say 6.5%, 7%, all the way down to like a 2.5%, just doing Streamline after Streamline. So it's very easy to do. And I think the best part of this is that you should just buy a house right now when you're going to get a better deal. And especially in the holidays right now, people are not looking to buy as much. and people are scared of the rates right now. So I would take advantage of that and go get a house knowing that I could do a streamline like this. Because I think some people get scared that, you know what if I get a high rate and I get laid off?
Right.
Or what if I get a high rate and let's say their income drops? Like, or maybe they just don't want to go through the whole process. They don't want to do the whole paperwork again and all that stuff. It's a very easy process to just do the FHA Streamline and lower the interest rate. Now, now let me ask you a question, because I do want to give I want to give the correct information here. What if somebody loses their job or they get laid off? If they get laid off, would that disqualify them from the Streamline?
So there is no income verification when it comes to a Streamline refinance. So whether or not the person is currently employed, or whether or not whatever the case may be, we don't order verifications. We don't need pay stubs. We don't need W-2s. In the eyes of the bank, or in the eyes of the housing administration, is if you can afford your payment at a higher rate, then without a doubt you can afford your payment at a lower rate. So whether or not you're employed at the time of the Streamline is irrelevant to us.
Yeah. So in other words, we just got to get the whole file. We got to analyze it, and then we'll see if it could go through.
Exactly.
Cool. So a lot of people also right now, they have a hard money loan, and those hard money loans are coming due. So for those hard money loans that people have, what is the best option right now? And have you helped anybody get out of a hard money loan?
Yeah, and it's great that you bring it up, because, in 2020, 2021, during the COVID era, what a lot of people were doing is they were, using equity or potentially taking on hard money loans to do home improvement projects, to build ADUs, to improve their current home. And these hard money loans are short term. So they're 12 to 24 months. It's something that, with a hard money loan, once it becomes due in full. So if you have a client that maybe took out $300,000, $400,000, $500,000, by the time the day after that loan becomes due, the foreclosure or the notice of default is issued, and that's when the foreclosure process would begin. So what's important to kind of take into account right now is these loans. It's it's not like you're working with a big bank, or like you're working with someone that's gonna be a little more lenient. You're working with private investors, and in essence, sharks loan sharks that when that loan becomes due, they're gonna do everything possible to make sure that their return of investment is there. So just a story that I recently dealt with is I had a borrower who had recently taken out a hard money loan to build an additional unit for income purposes on her property. So what we were able to do is that loan became due, I believe, about 2 weeks after I took over the loan, because they had previously gotten rates from other lenders. And then just a complete side note, something to consider is, as a broker, I 9 times out of 10, we're able to not only match your current scenario, but beat it, because we have a lot more flexibility in the banks that we work with and in the price points that we provide. But long story short, this borrower went to a few different lenders prior to coming to directly to me, and presented the scenarios. And I flat out told her that the scenario that we were looking at was just unrealistic, not possible. And I encouraged her to see if that was factual. And what ended up happening is, a week later, everything switched up, all the terms switched up, the rate, the cost, everything. So what we were able to do for that specific scenario is not only get her out of that hard money loan, we did what's called a DSCR loan. And in essence, what this is, it's a debt service coverage ratio loan. We were able to determine that the rental income, the anticipated rental income for that additional unit that she built, was enough to cover the difference in that mortgage payment. So in turn, we were able to justify that refinance, although we were potentially not qualifying with our income alone. So something to consider is, you want to make sure that when you're specifically in a situation like that, you want to make sure you have a great team behind you, someone who's actually gonna, fight for you and bat for you. And this deal was actually a deal that we financed with Conquer Escrow. Yeah. And I remember, that those last couple of days, we were back and forth with the lender, in some cases, just kind of very escalated conversations, because they're not in the business of cutting you any slack. They want to get get paid. And if you don't pay them per agreement, they're going to foreclose on your property. So what we were able to do for this client is, we went to bat for them. We were able to negotiate an extension for them. And, long story short, we were able to get that financed for them. And we were about a week away from them moving forward on a foreclosure on the property. So both the client and her family were very appreciative of that. They're business owners, self-made, and, they work very hard for their money. And this was an investment that they decided to make as a family. Some people may not be very well informed when it comes to hard money lenders or hard money loans. So it comes back to, understanding the terms of your loan, but more than anything, knowing and having that confidence that who you work with is going to inform you and fight for you as if they were fighting for their own loan. Yeah.
So now not any loan officer would go out of their way to do this, right? Like what makes you like fight like this for your clients?
I think what it is more than anything, we take it very personal. We take it very personal in a sense as, I met with this client. There was one of the conditions required us to get some court documents. So I met with her at the courthouse because she was an older lady. And, I kind of connected with her. She was telling me about how she migrated over and started her own business. And, she was like one of those diehard grinders. And that to me just really, kind of hit home for me because, this lady worked from nothing to create everything that she has. And, this is her hard-earned money. So when I see people like that, I just kind of put myself in their position. And I hope that, there's someone out there in the long run that's going to look out for me the way I look out for my clients. But without a doubt, the way we treat every transaction is more relationship driven than transactional. So much so that, we created a relationship and, we've gotten a few referrals from them as well. So they appreciate the work a lot more when it's genuine as opposed to, us pretending like we are invested when we really are not.
Yeah. And now if anybody here has any questions, you're getting approved, want to get pre-approved, or you want a second opinion, you can always reach out to us, comment or DM TMG, comment below or send us a DM TMG. Also, you can also text us at 310-801-6044. That's 310-801-6044. Now, remember also that here at The Mortgage Guys, if you're watching this podcast, we're going to pay for your appraisal. So if you run a pre-approval through us from this podcast, we got your appraisal. We're going to take care of their appraisal and give you the family and friends pricing here. So we're going to give you the family and friends discount on your interest rate. We only do this for family and friends, but we're going to do it to anybody watching this right here, right now.
That's right. That's right.
So now, if somebody is saying, you know what, I don't want to run my credit now. I don't want to get pre-approved right now because I want to qualify. I want to buy a house in the beginning of the year. So would you say that it's better to get a pre-approved right now so that they're ready for the beginning of the year? Or would you just wait till next year?
I think when it comes to the fact that people want to wait to find the perfect property before they get approved or before they before they start looking or get introduced to the real estate market, whatever the case may be. In essence, what it is, it's kind of like going to the mall. While your check, your direct deposit or your check for that you deposit into your bank account has not cleared. So you're going to the mall, you're checking out everything, you're looking at what new collections there may be, what outfit you may like, shoes, whatever the case may be. And then you find the one that you like and find out you can't buy it because you don't qualify. So you just built yourself up with this false hope and you're not prepared, you're not informed, and you really, you don't know anything aside from the fact that you like how the house looks. So it's important to get informed and it's important to understand the numbers and have someone on your side that's going to sit there and explain that for you, because in the long run, even in this high interest rate market, every property that you see out in the market will not last long. I mean, I'm still seeing properties that, they're receiving 5, 7, 8 offers, cash offers. So if you're serious about expanding your real estate portfolio and growing your network in regards to real estate. I think the first step is to get informed, understand where you stand. But more than anything, just kind of take that first step so that if and when a opportunity presents itself, you're ready to go. Because at the end of the day, you get approved today, that credit report is active for, 3 months. And realistically, aside from that credit report, as long as your employment doesn't change, as long as you don't take out a new car or open any new accounts or, max out any credit cards, as long as those factors remain the same, then your qualification will remain the same. So I do think it's important for people to get, informed and be informed buyers before they get out there in the market.
We talked about the DSCR loan. Can you explain for like the consumer watching this, like how does a DSCR loan work? Like what do you need to qualify for that? And we can also provide a DSCR loan all over the US, right?
Of course, yeah. So the beauty of DSCR, this is nationwide. It's not just California. Any FHA, VA, conventional, we're able to finance in California and Florida. But the beauty of DSCR is that there are no requirements or guidelines as to what state we're able to finance those in. So in essence, what a DSCR loan is let's say, for example, you're a self-employed borrower. You started your business. You were previously W-2'd and you decided to follow your dreams and start your own business. It's a new business. You maybe have about a year and it's been going amazing. Your income is more than what you imagined it to be. So you decide it's ready to start expanding your real estate portfolio, but you maybe don't have the tax returns to justify that. A DSCR loan, the beauty of it is you don't need any income documents, no tax returns, no pay stubs, no W-2s. We don't need realistically anything that would justify your income. The only thing that we're going to base your qualification on is whether or not that anticipated rental income is going to be enough to cover your mortgage payment. So as long as, let's say, your rental income for whatever property you're looking at is estimated to be $3,500, but your mortgage payment is $3,250, then that anticipated rental income is enough to cover your mortgage payment. So in turn, you now qualify for that property without any income documents, solely just based on that net market rent analysis.
What's the down payment for that?
The down payment starts at 20% and, it goes up from there just depending on if we're looking at a single family, duplex, triplex, fourplex. But it's definitely a program that has helped a lot of self-employed borrowers and business owners. Yeah. Because what we do see a lot, as a self-employed borrower or as a self-employed person in general, we make a certain amount, but our overhead as self-employed people, our overhead is there, our rent for the office, our lunches with clients or meetings, clothes. There's a lot of overhead that comes, at the end of the year once we're doing our taxes. So to avoid having the prospective borrower, maybe claim a little more income or write off a little or less items, we're able to avoid that as a whole and just solely go based on the net market analysis. So in the long run, it does benefit the borrower a lot more.
And what about cashing out? Because a lot of people have a lot of equity right now. Like there's never been this much equity in the U.S. in all homes. So also there's never been as much consumer debt.
Right.
So there's a lot of people that have credit cards maxed out and they have like super high interest rates on the credit cards. What are your thoughts on and what options do we have for anybody watching this that maybe they're like, man, I'm really overwhelmed with all my debt. I'm paying so much interest, but they also have a lot of equity in their home. Like, how can we help them?
Well, something to consider is everyone's talking about interest rates. Everyone's talking about the housing market. Are we at 6? Are we at 7? Are we at 8? But no one's talking about credit card interest rates. Credit card interest rates, people forget they are adjustable and they are dependent on where the market is at. So as you mentioned earlier, with inflation, everything going up, gas prices, the cost of living, everything that continues to go up, more and more people are using their credit cards, not just for vacations, not just for the luxuries or whatever it may be that they normally would use them for, but they're now using them for day-to-day grocery trips or gas or That's what people are using credit for. And in the last 2 years alone, that the consumer debt nationally has, increased significantly because of the fact that people are, you're using their credit more actively than they would previously. And just something to consider, when it comes to credit cards, as I mentioned earlier, they are adjustable rates. But, if we're going to look into potentially cashing out, people think, like I mentioned, 8%, 7%. People think that those rates are high, but they don't realize that, that $20,000 loan that you have, or whether it's a credit card or a personal loan, that you're paying 30% interest. That minimum payment that you're making, whether that's $300, $400, $500, more than 70% of that is going straight towards your interest. So something to consider, if you have a property, whether it's a primary or an investment, there are options for you to be able to leverage that equity and pay off that debt, consolidate that debt, and be able to take advantage of the equity that you have built as a homeowner. And that's one of the benefits as a homeowner. In essence, it's kind of like a bailout, but not really, because you're just consolidating that debt into a much, much lower interest rate. In turn, what that's going to do is that's going to increase your credit score. It's going to decrease your debt. And in the long run, although your credit score may have taken a hit depending on your credit utilization, we're going to pay all that off. So in the long run, 6-12 months, we're able to refinance again. Once you have a solid FICO, get your rate even lower at this point. And, it's a win-win. Just something, a complete anecdote. A file that we just funded actually out in Florida is, our borrower was, he was a business owner. He was a great, he had a few businesses, and he had his primary home. He had a few other investment properties. And in the last couple of years, business kind of slowed down. So, a lot of the overhead, a lot of expenses went into credit cards, went into personal loans. Certain banks, they'll freeze, if you have a HELOC or whatever the case may be, when times get tough and, they see that credit score taking a hit, they'll freeze your HELOC. So what ended up happening is, overall, for all the accounts, I kid you not, it was a solid, maybe 25, 30 accounts, combined minimum monthly payments. We were looking at least over $15,000 a month, including the current mortgage. What we were able to do is we were able to leverage his equity from his primary home and pay off over $120,000 of debt, pay off additional liens that were tied with the property, and still in the long run save him about, I want to say, at least $11,000 to $12,000 a month, because although his mortgage payment initially did go up because of the refinance, with a higher loan amount comes a higher mortgage payment, right? But the unexperienced mind will say, well, your payment's going from $2,500 to $3,500. How does this benefit you? But the experienced mind will say, well, we're paying off 30 accounts in full, and each one of those accounts has, $500 minimum monthly payment, $600, $400, $300. So all of those minimum payments, they add up. Yeah. So what we did is we leveraged the equity. We were able to pretty much wipe out his whole debt. We set him up with a plan to touch base, within 6 to 7 months, once the credit score has taken. Now he's zero debt, saving $12K a month. And although his mortgage payment did increase, we have a game plan to bring it back down once the credit score reflects those accounts being paid off.
So his total payments went down $12,000.
$12,000 a month because of the minimum monthly payment. It adds up. People think, oh, I have a $10,000 personal loan. Minimum payment is $500. They don't think about that minimum payment adding up. But if you take into account, the credit cards, if you take into account, other business loans, whatever the case may be, that interest, as I mentioned previously, is adjustable. So long story short, when the interest rate increases, so does the minimum monthly payment. And, people don't forget because you're just making your minimum payment. But, long story short, you end up realizing that your loan amount continues to increase month after month. So, we painted that bigger picture for him. And at the end of the day, he was very appreciative. So
if you guys have a lot of equity right now and you're thinking like, man, like I have a lot of equity, but a lot of debt, a good solution could be cashing out. So now remember, with the mortgage guys here, we're going to give you our family and friends pricing, meaning we're going to get you the best rate out there. Nobody is going to give you a better rate than us. And also, we're going to pay for your appraisal. So we'll take care of your appraisal, but this is only for anybody watching this episode of the Mortgage Guys podcast. If you want to get pre-approved to see if you qualify, just DM us, comment below TMG, and we're going to give you this deal that's only for people that watch the podcast here, the Mortgage Guys podcast. Now, maybe you're like, I don't know, like, what if I just get a HELOC or a credit line, whatever you want to call it? The thing that I don't like about those credit lines, the HELOCs, is that sometimes, because this happened to me in the past, like I had a credit line, right? And I was going to use it. Even like business credit lines, mortgage credit lines, but they froze it. In 2008, when the market got bad, they just froze it and disconnected it.
Yeah.
So now I couldn't use it and I needed that money. And then they just killed it. So then I was like, man, if I would have just refinanced, cashed out the money.
That's liquid.
Even though I have a higher payment maybe or a higher interest rate, I have the money there liquid. So if an emergency comes, for example, like maybe your dad gets sick or your mom, you don't have that liquid anymore because they're going to cut your credit line. They're just going to stop it. So what I suggest is get pre-approved first. See what you qualify for. See if you even qualify. See what you're going to get, your payment. And you don't lose anything. And then we go from there. So Frankie, where can people reach you? And then also, if you're a Spanish speaker and you're watching this, we're going to do the show in Spanish. And every week, we're going to bring you another episode of TMG Podcast. We want to get your questions, answer everything. And like I said, if you want to get pre-approved by us, reach out to Frankie. Send us a DM, comment, TMG. And Frankie, where can anybody watching this reach out to you? And also, one thing that I want you to also bring up is how you help realtors get more business. Can you talk a little bit about that to close out? And also, where can people reach you?
Yeah, of course. And prior to that, I did want to mention just one thing is, you mentioned earlier the pros and the cons of a HELOC or a home equity line of credit. Aside from it being able to be frozen at any point, it is also interest only. So you're not paying into the principal. It's just interest only. But another factor that I was talking to one of our account executives about is our standalone seconds. So with the new guideline that's being introduced in regards to ADUs, more and more people are looking into building building that additional unit on their property. So with a standalone second, it's pretty much like a cash out. You're leveraging your equity, but you're not affecting your initial rate. So it's a separate loan. Depending on how much equity we have on the property, you're able to use that equity to build that ADU to generate that additional income, and you're still not touching that 3 or 4% rate that you would normally do with a full refinance. So another benefit, as opposed to a standalone, as opposed to a HELOC, would be that standalone second, because you're leveraging your equity with generating a secondary lien on the property and not touching your first lien. Yeah. So something to point. Go ahead. Because
we want to keep it real here with TMG podcast. We want to make sure that we give you like the realness here. And like if you have like, for example, like if you maybe some people got a 1.99, remember?
That's right. Yeah.
So if you have a 1.99, like, I mean, I'm not going to recommend you like, hey, do a straight refinance because you're going to lose that 1.99. I don't think people will ever get it better than the 1.99. So if a client comes to you and they have like a 1.99 or a 2.5, would that be your recommendation? Get the standalone second?
That would be my recommendation. And at the end of the day, as I mentioned in the beginning, is we are based on relationships. We're relationship driven, not transactional. So I've had clients come and say, hey, I want to do a full refinance. I want to do this. This is my plan. And after I look at the scenario, I'm like, honestly, it does not benefit you. This is the breakdown. This is what does benefit you. And in turn, they appreciate that. They trust me and they trust my word. And they're not only going to continue to do business with me, but refer me all their friends and family, because they know that I'm not just trying to make or close a deal, whether or not it benefits them. They know that I am in turn looking out for their best interest. So just to answer your previous question in regards to what I do to help realtors is what I do is, now what we're seeing is more and more hesitation from buyers and, people not being informed or maybe people being misled. So what I like to do is I like to make sure that our borrowers are well informed. They are confident and they have everything that they need going into this transaction, whether it's worst case scenario or best case scenario. But more than anything, I make them a part of the transaction. Whether we're dealing with, obstacles through the transaction, whether we're dealing with verifications of employment issues, whatever the case may be, I partner with the borrowers in order to make them feel like they were a team in this. And, I'm not just going to leave them in the dark. I do everything and that's in their best interest. And at the end of the day, us as lenders or as realtors, we work for our clients. I know a lot of people kind of get that confused sometimes, but it's very important that we determine and we consider that we work for our clients. We cannot do anything that, maybe we think it's the best route to go this way, but they want to go that way. All we can do is inform our clients to the best of our ability and allow them to make the decision for themselves. And where people can reach me is Instagram is just straightforward Frankie Fragoso. That's my handle. And, you guys can text me or email me 323-497-2456. My contact is also on my Instagram. I'm more than happy to review any scenarios. If you guys are dealing with tough files or, we're a brokerage, we work with multiple different banks. So we're able to provide different terms for you guys.
And we'll put all your information below and we'll see you next week.
Sounds good. Thank you for tuning in.